Welcome to Trading Nation. We're pleased to be joined once again by Torsten Slok. He is Chief International Economist at Deutsche Bank. And, we've often said, Torsten, because we show the stock market returns around the world, Asia's up, Latin America's up, Europe's up, America's up, everything is up, literally except for basically Russia. And that we say, is the world economy actually this strong? You have proof that not only maybe is it that strong, it could be the strongest it's been since either of us was alive.
That's true, because the chart is basically using the IMF data to count how many countries in the world are in a recession. So there's about 190 countries in the world. And this chart shows you that today we are at the lowest level that we have ever been at before in terms of number of countries that are in a recession. We have never seen a smaller number of countries in recession as we do at the moment. And if you look ahead for the next few years, as the chart shows, we are going to see that fall even lower. So yes, you're absolutely right. The global economy is actually in great shape.
Yeah, it's going even lower. I'm trying to figure who are the countries that are in recession. I know with Venezuela, probably North Korea, we just don't even know about here. But I would imagine also that the countries that are in recession are probably small enough, if I don't know who they are, that they're not going to make a difference much anyway, are they?
Yeah, so this is countries like South Sudan and Yemen and like several other countries in Africa. So generally speaking, it's not any of the OECD countries. It's not the G3 or G7. And this is, of course, very important because this may be counting the number of countries. But, of course, it doesn't say how important are they. But it's critical, of course, that the G7 and the G20 countries are still doing really well. And in our forecast, we do expect growth to continue to look strong. So in that sense, that's not to say necessarily that stock market valuations are justified. But our message is very clear that we cannot see a global recession on the horizon. This chart very clearly tells you that this is not the IMF expectation either.
Yeah, okay, good. No global recession on the horizon. I guess here's the question. There are only a few countries, I imagine, that have the power to pull everybody down. One of them would obviously be the United States if we weaken the rest of the world. China, probably. Germany, maybe. Who could bring that to an end globally?
Yeah, so a very important answer to that question is that if there is no recession on the horizon, and if there is no sign that the US or Germany or Japan or China is about to slow down in a significant way, what could then stop the rally? What could be the real trigger for turning things around? And I think that the irony of all this is that the risks are not so much of a recession. The risk that we're facing in markets today is that there's a significant bigger risk of overheating. And what I mean by that is that when you have relatively strong growth and the US economy has been producing close to 3% GDP growth now for several quarters, then you do come to the point that you eventually see inflation starting to pick up. That's not what the consensus expects. That's not what we expect. That's not what the Fed expects for the next several quarters. But the biggest risk to all this is that we do start to see inflation pick up, and therefore the Fed having to raise rates faster than what the market is expecting. And that's why the answer to your question is that I don't think there's so much downside risk to global growth. It's really the risk of overheating and the risk of inflation that we should all be watching out for, and not only in the US, but also in a number of other bigger countries.
Because markets react ahead of time. So far, viewers wait to see a recession. It's too late, probably. The markets theoretically are going to discount something. Right now, they're obviously not discounting anything but good times. Do you expect the good times are going to keep rolling for the next couple of quarters or years?
The next 6-9 months, I do expect that the good times will roll, where stocks should continue to do well, credit spread should continue to narrow. But remember, the most important reason, why don't stocks like inflation? Why are stock markets so worried about inflation? Well, the answer to that is that once you see inflation, then the Fed will start to step in, then the ECB will start to step in and raise interest rates. And remember, the whole idea with raising interest rates is to cool down the economy, is to cool down revenue growth in companies. And from a stock market perspective, as a stockholder, I start to get worried when I hear stories about that the Federal Reserve or the ECB or central banks want to cool down revenue growth. And that's why historically inflation, the link between inflation and the stock market not doing well, is that the associated link in between is that central bankers begin to cool things down. We're not quite there yet, but it's clear that the Fed is on this path of raising rates and cooling things down ever so slowly. But if they do see a pickup in inflation, they will start to pick up the speed of slowing things down. And that's when equity investors should start to get worried.
Okay, we'll get you back on when that happens. Could happen in December again, but we'll see what the pace is. It's not about the rates, right? It's about the pace.
That's
Torsten
exactly right.
Slok, Deutsche Bank Chief International Economist. Torsten, thank you. Really interesting stuff.
Thanks for having me, Brian.
And folks, as always, thank you for watching Trading Nation.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.